Hello, and welcome. For the best viewing experience, we suggest that you close all other programs and turn the volume up on your computer. For optimal viewing, we recommend you use the side-by-side view to see the presentation as well as the speakers during the session. You can select this option by hovering over the top right section of your viewing screen and selecting the icon highlighted in blue on this slide. If you hover over the bottom of your screen, you will see the WebEx Controls. We have muted all attendees for today's presentation. If you have questions throughout the presentation, please use the Q&A feature located under the More Options button at the bottom of your screen. A box will then open on the right-hand side of your screen where you can type and submit your questions to the host, one of the speakers, or all of the panelists. If you're experiencing technical difficulties during the presentation, start by clicking F5 or submit a question to the host through the Q&A feature. If you're unable to do that, please email meetings@mossadams.com. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. It is now my pleasure to introduce you to your moderator and panelists.
Good morning, everyone. I'm Rich Anderson. I'm a managing partner of Moss Adams Capital. We are the investment banking arm of Moss Adams. On behalf of the whole Moss Adams family, it's a pleasure to be with you. Moss Adams Capital is engaged in helping clients navigate both shareholder and corporate liquidity needs and objectives. Beyond Moss Adams Capital, we have an entire team within Moss Adams that's very focused on all of the stimulus funding programs that have been developed and are being implemented, and as recently as 3 days ago launched this MSLP program. So we are here, we're on standby, ready to assist you. I'm also pleased to introduce 3 panelists that have joined us today that have extensive commercial lending experience on behalf of their organizations. We have Robert Loffink at U.S. Bank. Robert, would you care to introduce yourself, please, and tell us a little bit about your bank?
Sure. Thanks, Rich. Well, I appreciate everyone taking the time to meet with us today in the crazy new COVID world that we live in. Yes, I've been with U.S. Bank for about 16 years and have been working in banking and risk management for more than 20. I've had a lot of experience kind of working with government programs, roll out everything from large capital implementations, Basel II and Basel III, all the way through to some of the more real-time programs like the PPP loan program and now the Main Street lending program. So U.S. Bank's 5th largest bank in the country with a nearly nationwide footprint. So we're proud to be able to partner with Moss Adams today, and hopefully we can answer some questions and help people understand and start to figure out this new program.
Great, thank you, Robert. Jason Gill is with us from First Federal. Jason, please introduce yourself. And Jason had some technical issues earlier. We may not be able to hear him. Let's try.
Hi, Rich. Can you hear me?
Yes, wonderful.
Okay, great. Well, thanks for having me, and we're honored to be here as First Federal Bank. We're going to represent the community bank aspect of this opportunity to roll out Main Street. So First Federal is a $1.3 billion bank headquartered in Port Angeles, and our footprint is primarily Washington. We've done a couple of opportunities in the Portland area, but we are going to represent from the perspective of what a community bank would look for in the Main Street lending program for myself personally, I've been a lender for about 30 years, and I've worked with both larger banks and community banks for about the last 5 years. So thanks for having me.
Great. Thank you, Jason. And Jim Morehead is joining us from Bank of America. Jim, please introduce yourself and tell the group about your activities at B of A.
Thanks, Rich. So happy to be here on this panel. Welcome everyone into my home for our virtual event here. So I'm with, as Rich said, Bank of America. I run the commercial bank for B of A for Washington, Alaska, and Hawaii. I'm based in Seattle. And I've been with B of A for about 5 years now, with GE Capital for 20 years prior to that. We have been very active, as you can imagine, the last several months in helping our clients navigate this incredible time. We've, just to brag on B of A a little, have issued about $1.6 million in deferrals for consumers. We've committed on the philanthropic side, when it first came out, $100 million toward COVID relief and to help communities with that, and then recently announced a $1 billion commitment toward advancing racial equality and economic opportunity for minorities and in low-income areas. So very, very proud of those efforts by our bank. On the commercial banking side, we're providing everything you would think that a company would need in credit, treasury, cash management, international, and that's where our focus is in the commercial bank. Thanks, Rich.
That's excellent. Thank you, Jim. Okay, Caitlin, could you move to the next panel, please? So we're going to cover today the Federal Reserve's MSLP program, but I thought I'd just throw out some stats. Obviously, our economy was in great shape through February, and then suddenly it was put in a self-induced coma. The amount of action that has been taken by the Treasury Department in conjunction with the Federal Reserve is amazing. It's astounding figures when you think about it. You're all familiar with the PPP program that was launched by the SBA. I looked at the stats through May. There's over $510 billion in proceeds made available to small businesses across the country through 5,500 lenders and 4.4 million loans, and that continues to grow from there. The Economic Injury Disaster Loan Program, the woman that runs the SBA was on this morning on TV, and she said that they had some challenges implementing that program, but they've worked those out. And to date, they stand at $100 billion in proceeds outstanding. Now, we're going to overlay what we're here to talk about today, the Federal Reserve's program. It's earmarked at $600 billion. So you're looking at, well over $1 trillion in liquidity that's going to be flowing through the economy, ideally keeping people employed, enabling people to make fund their obligations, their near-term obligations, and get this economy rolling again. So again, an astounding number of actions taken. Some could certainly argue that it was a little sluggish at first, but this is all new territory. And one thing I'll also throw out is a kind of a bit of an obvious statement on the MSLP program. It just launched 3 days ago, so we're all scaling a learning curve right now. We'll strive to be as informative as possible, but literally every day new information is coming out on the program, and we'll very likely have another one of these webcasts in the coming weeks to provide an update on the program and any adjustments, any modifications to it. So if we could turn to the next panel, please. So the program is, again, $600 billion. The launch date was effective 3 days ago. So this is all hot off the press. The Federal Reserve is the underwriter and will underwrite 95% of eligible loans, with the remaining 5% coming from eligible lenders. Eligible lenders must be U.S. FDIC institutions, and eligible borrowers are businesses with up to 15,000 employees or $5 billion in 2019 annual revenues. So the types of loans fall under three buckets we'll cover on the next panel: new loans, priority loans, and expanded loans. The primary terms of the loan is a 5-year amortization, deferral of principal for 2 years. I believe interest is also deferred for the first year. Limitations: borrowers must commit to refrain from using proceeds to repay other loan balances. We'll get into that in a little bit more detail later on here. Caitlin, please go to the next panel. So here's an overview of the three programs: the MSNLF, that's new loan; the priority loan, MSPLF; and the expanded loan, MSELF. So the minimum, these are 5-year terms across the board. The minimum loan size for both the new loans and priority loans is $250,000. The maximum for the new loans are $35 million, or a formula based on a debt to EBITDA multiple. And under priority loans, it's that $50 million, lesser of $50 million, or again, the formula at a 6x EBITDA multiple. Then finally, under the expanded loan program, it's $10 million for a minimum loan size and up to $300 million, or 6x adjusted 2019 EBITDA. The lenders are retaining 5% of the loan balance and the risk associated with that. The payment terms: again, it's a 5-year term, no principal amortization in the first 2 years in each of those categories. The pricing is pretty aggressive at LIBOR +3. So this is meant to be a program to induce borrowers to participate in the program, to tap this facility, put that money to work in their business, again, retain people, stay in operation, and ideally benefit from a very favorable repayment program when their businesses have recovered and are performing quite nicely. Let's go to the next panel. So under borrower certifications, Jason, I wanted to ask you a question here, if you will. This first bullet point: the eligible borrower must commit to refrain from repaying principal balance or paying any interest on any debt until the eligible loan is repaid in full. Now, there's a condition. It says that unless debt or interest is mandatory and due. What it said mandatory, is that a term loan that has a mandatory principal payment?
Great question. So the short answer to that question is the Main Street loan cannot be used to accelerate debt. So if you have existing loans out there, you need to keep those loans in place until such time that the Main Street facility is retired. There's other issues related to collateral, which we can maybe get into a little bit of detail. But if you have real estate as collateral, that can be separate and outside of the facility. But Main Street's going to be pari passu with the other facilities, and it cannot be used to accelerate other debt.
Okay. So the goal here, they're not viewing this. This wasn't set up to be we're going to recapitalize and refinance everyone's debt within a particular organization. It's really just meant to be an additional loan with additional proceeds. So let's move to the next panel, please. So how will EBITDA be calculated? This is similar to the lender's existing methodology. So each lender that's going to participate in this program will have their methodology for computing EBITDA and any adjustments that would be qualified adjustments to come up with adjusted EBITDA. Now, I'd like to ask, Jason started to touch on this, but I'd like Jim to answer this next point in terms of how does MSLP interact with other debt owed by a company? Can you explain kind of where this sits in the debt stack and from a priority standpoint or, pari passu basis?
Sure, Rich. So I think one really important point to note with the Main Street Lending Program is that they're asking each of the banks to underwrite. It's very different than the Paycheck Protection Program because each of the banks is underwriting this debt to their own underwriting standards, and that's why there are EBITDA leverage calculations involved in this. And so the point of this program is it's not a forgivable loan like the Paycheck Protection Program, but rather the federal government is essentially standing up another bank. So it's another access to capital for companies. And it is meant to be, it's kind of like a federally owned bank. And so it's asking each of the financial institutions that are participating in this to underwrite like they are lending the money themselves. So with that, how it works with your other debt is that it can, if you're doing a new loan, which is this Main Street new loan funding, then it can have its own collateral. It can have second lien on your existing loans, on the collateral that are already out there. And it's underwritten to a 4 times EBITDA. If it is one of these expansion loan facilities, the priority loan or the expansion loan facility, it can be, it's basically adding a bank to your existing loan group. And it can be in, and that can share in the collateral, in other words, pari passu, or be in a standalone lien position. All of the debt, it's important to note, is basically senior debt. It's not subordinated debt. So again, this is like another senior lender coming into your bank group.
So Jim, let me just have a follow-up question. If someone participated in the PPP program, can they participate in the Main Street program?
Yes. They made that very clear.
Okay. Just wanted to make sure the audience was aware of that.
And
good.
I will emphasize again the statement you made earlier, Rich, that what's interesting about this program is, unlike the Paycheck Protection Program, they've taken a long time to get this just right. And so the goalposts are still moving a little bit, and they this is subject to other changes, like you said at the beginning, Rich. Whereas the Paycheck Protection Program, they rushed out a lot of money into the system. They didn't have everything figured out, as I think most people are aware for reading all the articles. And so, they got a lot of money into the economy, which is great, but it took a while to get all the right rules in place, and they're still adjusting that. This one is taking more time. They've been a little more prescriptive about it.
Got it. That's great. Okay, next panel, please. So there's a number of points on this, but I think what I'd like to draw, because this is something I've heard a lot of chatter about. Robert, maybe you can answer the question. This third bullet point implies that loans are not automatically. I'm sorry, I'm moving out of order here. On 15. Let's see, the compensation. Yeah, so compensation and stock repurchase. Jason, can you address what limitations there are on compensation, stock repurchases, and any dividends or distributions?
Sure. again, let's get back to intent. The intent of Main Street is to support existing businesses and bring them to the other side of the virus so that we retain employees and keep existing businesses afloat. So the spirit of it is to not allow dividends and distributions for other purposes. So you can't fund the Main Street into a good performing company and then funnel those monies out to a non-performing company. The proceeds need to be used specifically for the purposes of the company that is borrowing the money. You can distribute out to the extent that you need to pay taxes. So those are explicitly allowed, but there are no distributions above and beyond the tax consequences associated with the ongoing profits. On specifics related to employee compensation, the short answer is that you're allowed to do salaries for sure up to $425,000. Above that, you've got to be really careful because you cannot increase owner's comp during this period of time until the Main Street loan is retired in full. And then there's even a 1-year waiting period after it's retired in full where you're still limited on owner's comps.
So that's obviously a protection to try to avoid making this a real personal liquidity event. In other words, an owner taking a very, very big distribution with the proceeds and holding it personally. Okay, very good. Next panel, please. Okay, there's a number of points here, but I think I'll zero in on the third point here and ask Robert. This bullet point implies that loans are not automatically approved. What will banks be focused on when evaluating an application for MSLP?
Yeah, that's a great question, Rich. So I'm going to piggyback on something that my fellow panelist Jim brought up in his last comments, where he talked about the idea that banks are required to underwrite this to their own standards, and so that's really how the banks are going to be looking at it. So I think and the reason for that I would actually say is twofold. One, from the bank's perspective, U.S. Bank, as well as I think most banks out there, considers themselves a relationship bank, right? We don't just execute transactions. We like to build a relationship with our borrowers. And if you're doing that, you want to set up your borrowers for success, because if they're successful, you're successful. So I think there is a proactive discussion that needs to happen here, where even if a customer can check all of the boxes and is technically able to borrow it, the bank has to sit back and kind of go, okay, is this really a good risk both for them and for us, just from a relationship standpoint, because we want to see our borrowers succeed. On the flip side of that, I think you look at what the Main Street loan program is really intended to do, and we've kind of touched on that a couple of times. It's, as I said on the outset, I've gone through a number of these program rollouts, and it's really easy to get lost in the detail, and it's helpful every once in a while to take a step back and look at the big picture and really understand what's going on and what the intent or what the goal is. The Main Street loan program, we had the Triple P program, which got money out quickly. It was really designed for small businesses. And everyone saw the headlines that there were some larger companies and some mid-sized companies that took advantage of that, and they received some negative press for it. The other thing that's been rolled out by the Fed is that the Fed has been very active in the corporate bond market. So they're buying up corporate bonds. So if you're a really large corporate and you have bonds out there, you're already being supported by the Fed, by their activity going down into the, not just the high-grade bonds, but, the lower tranches as well. And the Main Street Loan Program is really designed for that middle ground, for that, for the companies that aren't the large corporates that have the bonds out there that the Fed can just go out and buy automatically or buy through an index fund. And it's not for the small businesses, but it's trying to address this for the medium businesses. And so, when you look at that, you want to get the right funds to the right company. And the Fed, which has never been excited to be in a position of trying to pick winners and losers in the economy, are really relying on the commercial banks to do this analysis. And that's why we have to look back at it and say, who was a strong candidate going into this, and they've just hit a rough patch due to COVID, and will this get them through? And you really you want to answer those questions to see if this is the right product for this customer at this time.
That's interesting. So the credit criteria is really intended to be, these aren't businesses that were suffering mightily in 2019 that suddenly now have a lifeline. These are businesses that were by and large doing quite fine in 2019 and then hit the wall with COVID. Is that what you're saying?
Correct. Yep. And so there's going to be a lot of focus from the bank's perspective on looking back at, ensuring that it was a viable entity going into this. And then I think, again, an idea that Jim put out there was that these aren't grants, these aren't forgivable loans or forgivable, there's no forgivable part to this. This is actual debt. So there's going to be a really big focus on pro forma. If your cash flows are impacted today because of COVID, what is the expectation that those cash flows can come back over the next 2, 3, 5 years when the amortization of this loan does kick in, especially with the balloon payment hanging out there? That's something I think both borrowers and lenders need to pay a lot of attention to.
Great. Very good. Thank you. That was great. Okay, next panel, please. Okay, so EBITDA, again, we talked a little bit about this earlier. So there will be each lender will use their methodology for computing this. So when you go to apply, you may want to have that conversation with them to get that clarification. We are at 30 minutes right now, and I was kind of given parameters to try to get through much of the discussion within 30 minutes and leave some time for Q&A, but I still have a number of questions I'd like to ask. So hopefully everyone is glued to their chairs and interested in hearing some more questions. So Jason, if I may, if a company's bank is not participating in this program, how should they go about finding a bank?
Great question. So the short answer is we got 3 great banks right here on this panel, so you can reach out to any of the 3 of us. But let's be clear, different banks are going to participate at different levels. Some are going to use this as a marketing tool. Others are going to use this as a defensive measure to help their companies that are struggling. So if I were in a business owner's shoes, I would reach out to my network and reach out and figure out which banks in my community seem to be out there supporting Main Street. It's brand new. It's only been out 3 days. So there's no yet word on the street as who's out there and who isn't. And then to further complicate things, the Fed's made it pretty clear that they're not going to release the eligible lenders and put that out on the web. So it's going to be more of a word of mouth thing to get the right answers and the right bank to help you.
Interesting. Thank you. Thank you. Robert, so now that we've talked a lot about the program, who's best suited to benefit from a loan under this program?
Sure. Yeah, no, that's a great question. And I think, like I said, this program was rolled out with a very specific sort of segment of the market in mind. The medium to large corps that don't have the ability to or don't currently have bonds out there on the market, and companies that couldn't take advantage of the PPP loan. program. And so, I think the candidates for this are kind of like I was saying before. It's really those entities that were going along fine. Everything, we all know that there were certain industries and segments, and as any banker can tell you, individual customers that were struggling before COVID ever showed up. And if there are deep technical issues with a business plan, and now COVID has just accelerated something that was already in process, it's going to be very difficult by taking on this additional debt. I mean, yes, you have deferral for a couple of the first years, but like I said, it's back-ended debt, and that can sneak up really quick on you. And so, so who are the right participants for this type of program? It's going to be those entities that were doing fine. Like I said, we go back and we look at the 2019 ending EBITDA. So that's the cash flow that you had available to service debt at the end of 2019 when everything was normal, quote unquote normal. We all have a new definition of normal these days. Then COVID hits, and for the temporary impairment that causes, this is an opportunity to smooth that out over 5 years and pay it off in kind. And ideally, especially with back-end loaded debt, as the markets come back and do you either pay it off in the full 5 years or do you refinance it as you get to that end? But it's going to be the companies that do have a legitimate business plan that will come back from this, that will be able to execute and pay down this debt and continue on as a viable economic entity. I'll be honest, this is just my perspective. I've done a lot of government programs over the years. They can be clunky. They can be hard. There's a lot of legal aspects that you're going to have to get opinions on. And so I don't see this as something that a company just needs a little extra debt to have in their back pocket just in case. If you have liquidity and you have access to debt already and a good relationship with your banks, then and you can rely on that, that's great. This is probably not worth the effort to go through it. But, if you do need it, it is a lifeline. It is worth that effort to go through it and make sure it's done right. And it will get you through to the other side where you can then have a bright future.
Great, thank you. So, Jim, given the size of your clients, you do business with some pretty significant sized businesses. What are you seeing up to this point in time in terms of their ability to address liquidity needs? And then, do you consider that are you hearing that a lot of your clients are going to be applying for this program?
Yeah, good question, Rich. It's interesting when it's clear we are moving into a crisis mode. We saw about 3 years worth of loan growth in about 2 to 3 weeks as companies immediately drew down their lines of credit, tapped into liquidity they could get from their existing banks, and it was a little bit of a panic there, as we all saw. Thankfully, this economic crisis is very different than the financial crisis 10, 12 years ago when banks and financial institutions were part of the problem, frankly, whereas this, banks and financial institutions' balance sheets are very strong and they're a big part of the solution. So thankfully, and we've seen that panic subside to some degree, even though there's still concern around the overall economic health for the rest of the year. But we've seen those loan balances go down quite a bit as clients are comfortable that their banks are going to be able to support them without them having to run and draw liquidity. So with the Main Street lending, I absolutely agree with Robert. It is very complex. They're still writing the rules to some degree. Banks are using their own underwriting standards, which are different, frankly, at all different banks. And so not everyone, and probably the majority of companies, will not tap into the Main Street lending facility. but it is meant to be an extra source of liquidity, an extra bank you can tap into without establishing a new bank relationship. Your primary source should come from your existing bank. The banks are having to underwrite it, so they need to know you as a company. They need to have done and know your customer and anti-money laundering work with your company and the individuals. So all of that definitely steers you toward your existing banking relationship, and that's primarily where Bank of America will be focused on is on our existing clients.
It's very helpful. So I'm going to throw a question out to any one of the three of you would like to, if all of you would like to answer. So an asset-based facility, frequently the underwriting criteria is the quality of the assets. It's not based on necessarily the P&L of the company. It's based on the quality of whether it's receivables or inventory, whatever the case may be. Do you see, because of that, let's say companies that have ABL facilities but may not have had very significant earning streams being having a real challenge tapping into this program?
I can take a shot at that. If there was an ABL facility that was set up with very tight cash flow covenants pre-COVID in 2019, I would say that this is probably not a good candidate for Main Street. However, there are what I would call asset-based light loans out there where they do monitor the assets, and the company's cash flow is, or at least in 2019, was significant to do, say, a debt service coverage of 120 or greater. In those instances, this could be a great lifeline because you've got the 2 years of essentially almost no payments. And then year 3, they can either look to refinance at that time or preferably just to continue on the debt schedule as needed with the 15% principal reduction. The advantage they have is with essentially no payments going out in the next 2 years, they can start building capital in order to make those payments 3 years from today.
Yeah, I guess the only thing I would sort of add on to that is I think now don't quote me on this because all this stuff is very new, but I believe I read in the frequently asked questions that there may be some parameters released in the near future that specifically address asset-based businesses. It's not out there yet, and again, we're all learning this as we go through it together. But ultimately, an asset-based company, whether you're lending against the inventory or the AR, that is going to convert into cash that will pay back the facility. If it's a working line of capital line, or it's cash that's going to pay it back. So I think when we look at asset-based lenders that may have traditionally not focused on cash flow, it's important to take a step back and just look at the working capital cycle that a particular company may be in. And there could be situations that at the end of 2019 they were not running their business to maximize EBITDA, and so that number looks a little off. And there may be a very legitimate case that could be built and say, that when you take a step back from the working capital cycle, that inventory that's sitting out there, those receivables that are sitting out there have value. They will be converted into cash, and you'll be able to take action off of that. So it's understanding the business, and I think that goes back to what Jim said of banks underwriting this to their own underwriting standards. So if you have a bank and they know your business and they know your cycles and they know how you perform both in good times and bad times, and they've got a 30-year banking history with you, and they have confidence in management, it's going to be a lot easier to structure and build that case that this is a legitimate loan for a legitimate company than somebody just coming in looking at the numbers, and the numbers just don't make sense, and you've got 500 other people calling you and you're just going to have to set this one aside and not get to it.
So again, another question for each of you. Can you explain how, let's say your customers in your organizations want to pursue this program? Are all of the loan officers going to be fielding those requests and managing through applications, or is there a specific team or department in each of your organizations that will manage this process?
So I'll speak for Bank of America. It is a complex program that's changing. So we do have kind of subject matter experts within our bank in each of our regions. So while our client managers will, of course, understand the inquiries and questions that clients have, we will pretty quickly get them in touch with a subject matter expert that is very on top of the updated FAQs that the Fed and Treasury Department issue and help with the program. I would also strongly recommend, while the banks are facilitating these loans, I strongly recommend having initial conversations with your Moss Adams partner, your CPA, as well as your attorney to understand eligibility, as well as if it makes sense for your company to pursue. Banks in general are not, and this is by order of the Fed, are not supposed to be advising clients on eligibility or some of the aspects of pursuing it, and that should be from your CPA and attorney. So I strongly recommend that.
Jason or Robert, for your organizations?
This is Jason. We're going to follow a similar game plan to Jim. So each one of our lenders in our market has the ability to extend Main Street facilities to any of their customers. But because of the complexities of the program, we have subject matter experts in our organization as well that will reach out to each of us, the subject matter experts, to get clarification. But in our shop, you're still going to maintain the relationship with your client manager.
Yep, and same thing with us. We're going to try to have our cake and eat it too, where we have a project management team that's in place to streamline the loan request, streamline the underwriting, streamline the approval process, get everyone lined out as quickly and as efficiently as possible. But we're not going to ignore the bankers who've worked with these customers for years, because they're our greatest source of information. These are still wholesale loans, which are highly customized to a specific company, and so having that detailed knowledge and history is hugely important, and we're not going to pass that up. So it's a combination of both.
Great, thank you. Caitlin, could you move to the last slide? There's a couple other slides that just talk about the senior lending community and then junior debt and equity capital providers. That's obviously another enormous pool of liquidity alternatives that can be approached and navigated. But if you go to the last panel, maybe I can do it. There we go. You're welcome to reach out to me if you wish. We have a whole host of team members in Moss Adams that are focused on this program that will help navigate this. That can reach out to the gentlemen that are on this panel with us. We are here to be a resource. We're here to help you navigate this program. There's an inducement to tap into these resources if your organization qualifies. It's an amazing program, and we hope that this discussion has been helpful. Caitlin, were there any questions that came in during our discussion that you could bring up on the screen?
I can read them off, or if you look to the right in the Q&A, we have had a number of questions. A few are, Is it true that if a borrower amongst its affiliates is a sole participant in the program, the borrower does not need to aggregate the leverage of its affiliates for determining the maximum amount of the loan?
Could you repeat that, please?
Yes, I can. Apologies. And hopefully you can see in your right-hand corner of your screen the Q&A where they've been coming in the box. But the question I just read was, is it true that if a borrower amongst its affiliates is the sole participant in the program, the borrower does not need to aggregate the leverage of its affiliates for determining the maximum amount of the loan?
Would one of you like to tackle that?
I honestly don't know the answer, so.
Yeah, as they continue to write the FAQs, I mean, I would encourage you to work through that with your CPA, honestly.
Yeah, I would go back to
that's where you should go.
Yep. I would go back to the frequently asked questions. I know there are specific rules around, only one entity out of a portfolio company can obtain a Main Street loan, but how other debt to other affiliates is aggregated. I mean, just from a simple matching principle, if you're aggregating all of the cash flows, you should probably aggregate all of the debt. But they as far as determining maximum loan amount, I think the frequently asked questions have some detailed information.
Sure. And by the way, Caitlin, I don't. My Q&A screen is blank, so that's why I'm not able to read the questions off myself. If there's we have time probably for one or two more questions if there are those.
Can you elaborate on the ability to refinance existing debt via the priority loan option? Do you have to refinance through a separate lender than your existing lender?
I can answer that question from the perspective of a new lender. So, First Federal is going to be out, as with many other banks, that will be using this for folks that we don't currently have relationships with. And if we are refinancing existing debt, we cannot have that debt accelerated. So we have to, as long as the Main Street terms are as favorable or better from a cash flow perspective, we can refinance the debt. But that's our limitation, is we can't, we have to keep if we keep existing facilities in place, then that's a possibility. But from a new lender's perspective, we're typically taking out all the debt and not accelerating it. The one debt that we wouldn't likely not take out would be real estate debt. And hopefully that answers the question from the perspective of a new lender.
Another question we have is, what happens if we sell the company during the life of the loan? How do we make distributions related to the sale?
I'll take a run at that. The loan would very likely have to be repaid with the closing proceeds. Would you all concur?
Would concur. I've been asked that question myself, and that's my answer, that the Main Street loan would have to be retired.
Very good.
Do we want to call that it for questions at this time?
No, you go ahead and ask another one.
Okay.
Yes,
They're coming in. Sorry. If you're not the existing lender, what kind of appetite will you have to lend under this program and layer on additional debt and increase leverage for that company?
Yeah, this is Jim. I touched on this a little bit.
I can try to tackle that again because I've been approached on a couple opportunities. So our perspective on this is that we're only going to make loans that make sense from our perspective. We have skin in the game, and we will allow some additional leverage if we believe that the long-term viability of the company is strong. And we're also, you know, this is just a more of an internal thing, but we're trying to make loans so that once at the end of the 5th year, that the loan would look like a normal conventional loan that would be financed by a bank. If it meets that hurdle or step, then we're interested. If we're still going to be looking at a loan that has, you know, lack of collateral or tight cash flows 5 years from today, then at least our institution probably would not extend credit.
Jim, you started to answer that as well. Would you like to add anything?
Well, I would just say it is undetermined which banks are lending, if they are just focused on the existing clients or if they are doing new loans for non-clients. I'd say definitely go to your bank first that you have a history with, to work with them. If you are talking to another bank, a new bank, you know, they're going to underwrite to their EBITDA requirements and their underwriting requirements. So different banks will have different appetites, and that's what's going to be tricky about this program. It's not a cookie cutter program that each bank's going to follow a script. And I'll also say, Rich, because I know we're coming up against it on time, a lot of the questions I see in the Q&A have to do with very specific scenarios for different companies, it looks like. And that is absolutely the right questions to ask your Moss Adams partner on the CPA side is, you know, different scenarios. That's the complexity of the program, is understanding all these different, you know, different scenarios for your individual company.
Thanks, Jim. Like I say, my screen is blank for under the Q&A, so my team is probably laughing right now because they know I'm the least technologically savvy person walking the earth today. It's amazing we actually got through this. So anyway, we'll go ahead and wrap up. If there are questions that are specific to your situation and you would like us to help you navigate, please feel free to contact me. If I can put you in contact with one of the panelists, I will. If I can put you in contact with one of my 300 plus Moss Adams partners, we'll be happy to do that as well. Again, we have an entire team that's dedicated to this program. So with that, I'd just like to thank Robert, Jim, and Jason for joining us today, and Caitlin for managing this. Very much appreciated. We wish you all the very best, and please feel free to reach out if we can be of assistance to you in any way. Thank you now.
Thank you, Rich.
Thanks, Rich. Appreciate it.
Bye.